Good to see you both, guys. Phil, the president's point is that the peak inflation narrative has traction. Would you agree?
We would agree with that. The only problem, Carl, is that the Fed's target is 2, right? So when you have an 8 handle on inflation, Fed put doesn't exist, okay, which a lot of people got kind of teased into in the last cycle, that if things got bad enough, the Fed would pivot. And for us last week, Carl, was a microcosm of the entire year, where investors were like, okay, maybe they don't have to slam on the brakes as much as they have. And then we get a really hot core number that firmly puts in place what I call a terminal rate problem. We don't know where the Fed's going to stop, and that's a problem, and that's why we're positioning defensively in portfolios. So
you agree the conversation last week changed on that terminal rate? I mean, now we're hearing from some of your competitors on the street, maybe 3.25 or 4.25, maybe 4.5.
Yeah, so where the market, the good news is that the market is priced to get to about 4.5. That's where the market is today. It went up by about 40 basis points last week, okay? That was a big jolt. That's why the S&P fell by 5%. The bad news for equity investors is that everything that you're taught, strong labor markets, good consumer, that stuff is actually inflationary, right? So we're in this weird situation of actually rooting for the economy to slow down to then make inflation come a lot closer to the Fed's target. And, Carl, that's not happening anytime soon.
And Phil says, we don't know exactly where the terminal rate will be. We also don't know how long, once we get there, we're going to stay there, which is something else that may be concerning markets. So I'm just wondering, where are you looking in this market to potentially find something that's worth investing in right now?
Well, it's a good point, and it is really tough out there now. Inflation is a real thing. I'm sitting in the Midwest. We certainly feel it here. But I think it is time for investors to start looking around the corner. We've priced in a lot of bad news last week. And I think what we'll see next week is what the market anticipates, this week, 75 basis points. And then we will see what happens next. It's likely that we'll start to see other things. Earnings estimates start to come down, like PPI is showing us the economy is slowing, inflation is starting to come off. And if those things happen, we could start to see the market price in something else. But right now, I think the market's done the appropriate thing and priced in a tighter Fed and one with interest rates going to above 4.
So, Phil, do you dip your toe into equities right now? Do you look at other assets, given the fact that we do have yields at multi-decade highs?
Yep. So not quite yet, Morgan. So in a 60-40 portfolio, every day I wake up and I try to beat a multi-asset index. We have about 52% in equity, so about 8% underweight. However, credit, investment-grade credit, held up remarkably well last week. Dave, last time we were on the show, we talked about cash. Cash has gotten even better. So there are places to sit and wait for the kind of inflation story to pan out, but Morgan, not quite yet in equities, because that margin story, that earnings story has yet to play out. But we would not throw in the towel on diversification right now. I mean, it's been an awful year, worst year ever for fixed income. We don't think that continues into 2023. That eventually helps sentiment when there are places to play defense.
So what, right now is a decent time to actually look at fixed income as an opportunity? I mean, clearly a 4% on the 2-year, which is what we're close to, has got to be drawing in some investors.
And, David, that's the best part. The yield curve is so inverted that in the front end of the curve, where you don't have to take that much interest rate risk, which is duration risk, you can find really nice opportunity for carry or yield. Obviously, cash is the ultimate safe haven, but also in short duration, short maturity, investment grade stuff makes some sense.